Welcome to Phil's Gang video. Now, I'm going to explain today to those people who never used a chart why charting makes more sense in the environment that we're in. In fact, almost in any environment. The thing you need to know is that if we go back to the 70s right here, let's go back to the 70s. It used to be simple. Life was simple then. Wall Street, these guys here, would take care of you. You invest money, and their job was to make that money grow. Now, how would they make that money grow? They would find what we call undervalued companies. Now, those undervalued companies, their stock would be, let's say, at $100, and the stock dropped, let's say, down to $30. Now, why would it do that? Well, most of the time that you'll find out when companies do that is because of management, bad management, that they're not getting enough return on assets or return on equity. Therefore, the institutions that own these stocks decide not to invest. Remember what a stock is. Okay? A stock is where all this money comes in, and most of the money that comes in, okay, about 75% of it is from institutions. You heard the word institution, okay? Now, what does the word institution mean? What is an institution? We're not talking the insane asylum, or should be, okay? The institution is what we call brokerage houses. Okay, now these are the big boys. Now the big brokerage houses, what they do is they buy these stocks before you buy them, and they mark them up to you. Now, the reason they do that is because the old days, when you had the stockbrokers, they'd wait for undervalued, they'd look at undervalued companies, stocks were at $100, broke to 30, and what would they identify? They'd identify that it did that because of the management is not getting return on assets, and they're not getting a good return. I hear return on equity. So if they don't get a return on equity, okay, and they don't get a return on assets, then what happens is the stock of this company, with all these investors come in, the investors start pulling out. They move their money to somewhere else. Remember, investors today aren't loyal. Back then they used to be. Somebody would stay with a stock on average 10 years. So what would happen is when the stock dropped from $100 to $30, even went down to, let's say, $10, the broker would identify that the company, everything else was good with the company, it was just bad management. So what they would do is they would start, a lot of the big institutions would start buying that stock themselves, trying to get good management in there, and they would. And so now the stock is down at $10, and all of a sudden, over years, as it keeps going on, these two things improving, return on assets, return on equity. So it was always the idea is to get undervalued companies. They drop, but make sure it was still a good company. And then the idea was to move the return on assets, return on equity back up. And your broker would oversee this. So his job was to make sure, he'd come over here, and his job was to watch the company, watch the return on assets, and also his own company, Goldman Sachs, whatever, that they would also buy a little bit of that company, and they'd stay with it for 10 years. So this was a pretty good deal on Wall Street, and that's where people made money. The Wall Street guys made $150 a share every time you bought a share. That was their commission or more. And they were happy making money. You were happy making money. But this all changed, as I told you before, this all changed when this all went away, when we had what? What happened? We had all this new technology come in. And with all this new technology coming in, okay, computers and all this stuff coming in, and high-speed trading and all that, okay, they no longer cared, okay, about finding undervalued companies, manage it, watch it for years for you, and manage it for years for you, because once technology came in, then all they cared about was making money, because once technology came in, they no longer were making $150 a share commission. Okay, that's when the brokerage houses, discount brokerage came in, and they could start out and they could charge you as little as $5 a share. So this concept, undervalued companies dropped from 100 to 10. These guys would watch return on assets, they'd watch management, they'd want to see this climb, they'd stay with it for 10 years, and then after 10 years, they tell you to get out and you made a lot of money. That was all gone. Now with new technology coming in at $150 and down to $5 what they were making, they had to buy the stocks first. So that's when they started out with what they call IPOs, okay? So, and what started the IPO frenzy was tech. It was the big tech. Okay, that's when, remember, we went from a smokestack industry. Everybody was making money on smokestack industries, okay, manufacturing, and they moved to smokestack industries and they went to technology, okay? They went to technology. And when they made that move from smokestack industry over to technology, Wall Street knew they could make much more money on technology on Wall Street, meaning buying companies. So they buy this company, they put this company out, this IPO. They own a lot of the shares themselves for like $2. And then what they would do is they would pump the stock up, okay, with the help of CNBC pumping it up, and they would put it out in the morning to like $50, say $52. So the company made, with their own shares that they owned at the IPO, from $2 to $52, so they made a $50 share profit, and they made a bundle of money. So now, how is that possible? Because remember, let's divide this so you understand. These days were gone right here, no more, that was gone. And because of technology, okay, all they cared about is bringing companies public, anything that had a tech in front of it. And no, they got rid of these. Matter of fact, they dismantled it and sold most of these to China. And so the whole idea was IPO was tech, and they could buy the shares at $2, pump into $52, and they owned the company. Now that caused a problem, because here's the brokerage firms were in direct. These guys here had a conflict, because what they were doing, they were working for who? They were working for the company over here. Here's the tech company. Okay, so this is your tech company over here. So they owned a lot of this tech company share, and they were looking out for their interests. And what they were doing is trying to pump the share price up. And then they said they also represented you over here. Okay, and now that didn't make much sense, because what they kept doing is they kept on pumping the price of the stock from $1, okay, up to $100, okay, and in between the $1 and $100, they were making a fortune, because remember, they owned a great deal of shares, and they were working with this company to make it grow. And so again, they owned all the share, and then when you, and here's the brokerage house. So here's the broker. He's got the broker desk here. Here's the broker desk. So here's the guy behind his desk. So this company we'll call X, or we'll call T. The manager of the brokers would come in the morning and say, I want you to pump. We bought a bunch of tea yesterday for, let's say, we bought a bunch of tea for $10 yesterday. We bought it ourselves. It's called in-house stock, $10. So he's going to now tell the managing broker here is going to tell all his guys, okay, all these guys here that are all the brokers, you know, Frank, Tom, Sam, all the brokers, hey, we're going to give anybody who sells this, we got 20,000 shares or 10,000, we want you to dump it. Whoever sells the most is going to give you a trip to Hawaii, going to give you a brand new car. So their whole deal was to get you on the telephone, okay? If they got you on the phone, and they would tell you what a great deal this stuff was, but remember, they owned it. So what didn't make sense is they would go out and they bought the stock, let's say they had the stock for $1, and now the guys on the brokerage desk, all these guys here, trying to sell it for 10, and they were pumping the stock through what they call noise, or the tape, or every day they go over to CNBC over here. Here's CNBC, and they tell CNBC guy, okay, I'll give you $1,000 if you pump my stock up for me. So the tape, okay, we'll call this the tape right here. This would be the tape. So it'd be always glowing reports on this tape, everything glowing. They'd have a promoter promoting everything about this company to get the price from $1 to 10. But it's really only worth $1, because remember, the brokerage company, okay, the brokerage company, these guys here bought T, okay, at $1. They're trying to get it up to $10, especially after the IPO. So the conflict always came is when this guy called Jerry over here, okay, here's Jerry, right? And he calls Jerry, there's Jerry, and here's the broker on the phone calling Jerry. Doesn't make much sense. He says to Jerry, hey, I got a good deal for you. Buy the stock at $10. And here's Jerry, and Jerry's happy. Tells him why. But wait a minute. If the stock was so good and the broker bought it at $1, why is Jerry over here so lucky that this broker would sell it to him for 10? So see the conflict? And then in the meantime, remember, the brokerage house is putting a tape out telling everybody all these wonderful stories and why you should get into the stock. And that's why the stock is going up with all these wonderful stories and all this pumping and promotion. And again, the broker's calling Jerry to say, buy more of this stock that they already bought at $1. The guy should say, why am I so lucky you're selling it to me? It was so good. Why don't you keep it yourself? So that's how it all started. So we went from this concept of buying undervalued companies where stocks dropped down from 100 down to 10, where the brokerage house was loyal to you. The loyalty was always on your side because he was getting paid a $150 commission. And he would watch that company as it being managed to get return on assets, return on earnings. And he was in your corner and because he was doing a good job for you and a good job for himself. This all changed when we got rid of the smokestack industry and we got to technology over here, and then again we got into discount brokerage, where instead of getting $150, the broker's getting 50. This guy's getting 50 instead of 150. So the whole concept flipped upside down. These guys were buying the stock first to flip to you, and then you were always buying what they call retail. So let's think about this. You were buying retail. That's like going into Penny's, and here's a suit for $100 in Penny's. There's a suit, and then you decide to take the suit outside, okay, the building. So you walk through the doors, you go outside the building, and you put it on a rack out here, and you think that you can sell the same suit, okay, for $200. Well, wait a minute. You just bought the suit for $100 retail. Now you're trying to sell it for $200. That's kind of tough to do. Well, that's exactly what happened when they got rid of the smokestack industry and everybody started with the tech industry, and the big brokerage firms, these guys here, were buying the stock first, right? They bought the stock first to sell to you, and they bought the stock at $1 right here, trying to sell it to you at $10. So what's happening is it was hard for you to make money because you now are buying stock at retail to sell it at retail, just like the suit. All right. So, but that's when the tech industry exploded, and that's when we had our first big bubble. Remember the tech bubble? Okay, so it was all through this promotion and of this tech, and it was a bubble because there was this tremendous demand. And at the end of the day, remember, when the demand stops, what happens? Well, sales stop, prices go down, people get laid off, and then stock drops from $100 back down to $5, and you have a crash. And that's what happened with the tech. All right, so let's take this, knowing all that. What's going on today, okay, is this. They decide now, so here's the first bubble. This was the tech bubble. Now, when it crashed, the idea is to make another bubble. So now they're going to make a new bubble. Now let's do a housing bubble. Okay, so these are all bubbles, and the reason why these are bubbles, remember, these are bubble masters now. The idea is to create bubbles. That's how Wall Street makes money, and to explain why, again, remember, when you take the brokerage houses and they no longer have the smokestack industry, okay, they're doing all these IPOs, and they're representing the companies. They own the stock themselves. They're selling it to you. They're going to push these stocks up as high as they can. And then when they can't push it up anymore and the demand stops and it breaks, remember, every stock breaks for the same reason. The demand will stop. At some point, the demand will stop. When either by inflation or price, something's going to happen to stop that demand, and it crashes. Okay? So that was the tech bubble. The housing bubble was the same thing. So what did they do? Same exact thing. This time, though, they lowered all the interest rates. You know how it went. Lowered all the interest rates, lowered all the credit standards, and they created a fake demand, right, by lowering interest rates, lowering the credit standards, and all this demand was going up. It was pushing up the housing prices, But remember, these housing prices that went from $100,000 and now all of a sudden your house is worth $185,000 up here, and you extracted out all the equity right here. You took all the equity out and you went and bought stuff. Okay, you went and bought stuff. You went and bought cars and all this crap right here. Then same thing happened. This time when gasoline went up or oil went up, guess what happened? People had to make a decision. They didn't have enough money. They had to make a car payment, or they had to make a decision between buying gas to get to work, okay, or their house payment, or their credit card. So they decided to keep the credit card, decided to keep money to get to work with their car, and so they let the house go. And then all of a sudden we had 11 million foreclosures, and people lost. Remember, when the house went from 100 to 185, this was all fake. This is called a bubble. This is all a bubble right here. Bubble. This is all bubble right here. This is all bubble. And the bubbles are always created by creating a fake demand to push this thing up. The idea is you got to know when to get out up here. That's the key, when to get out. That's when the rich become richer. They know when to get out. So now we got this new bubble called the QE bubble. So they decided, okay, the housing market crashed. Remember, the same thing happened. This happened, the same thing. This crashed because demand stopped. When demand stops, either by inflation, the prices are too much, or like in this case, by oil being too much, it always happens with a bubble. Because remember, the price from here, from $100, just use the stock, up to 185, whether it's a stock price or it's a house price, it's all inflated by a fake demand, either by lowering credit standards and cheap money, and that's what they did over here. The difference over here with lower money and credit, most of this was Wall Street people. About 70% of the people that were invested in the tech that got hurt were Wall Street people. Over here, this was the big one. This is the one that hurt. Okay, 70% of the people were households, because it affected their homes. Remember, they're taking all the equity out, and they're buying stuff with it. Now we got the third bubble, so now they want to create the third bubble. Why do they do this? Because that's how Wall Street makes money, creating bubbles. They make money on the way up, and guess what? They make money on the way down, shorting. Up, they make money shorting. So now the QE bubble had to start. They needed to make money again. So what did they do? Same thing. They had to create demand. So always remember, every one of these bubbles from 100 to 185, 100 185, $100 to 185 is what? How you got to create demand. So here's your demand, okay? And when you have demand, what happens? Demand, you have prices, right? Your prices go where? They go up. Prices go up. When you have demand, prices go up. So they will create demand by cheap credit, okay? And by low-cost dollars and easy credit. Low-cost dollar, easy credit. Here they've gone bonkers. This one I really went nuts. Okay, this they brought interest rates down to zero. Okay, zero interest rates, and again, availability to money is so easy right now. But they decided that the only people they weren't going to work with a retail customer here because they can't. Because he's out of money. He lost 11 million in foreclosures. He lost 12 trillion got wiped out in his equity. Okay, so he lost 12 trillion plus 11 million house in foreclosure. He can't play in here. So the retail customer, 42%. Let's take 42% of the retail customer. See, always all of these about 42% is retail customer. 42% is retail customer. Okay, so this guy is gone. He's gone totally. So the only ones that are in here are the Wall Street pros, okay, Wall Street pros. So they decided, okay, what are we going to do? We're going to create a demand again, our stock from 180, and they did that with what they call QE. And you know what that is now. We've done it 100 times. QE is nothing more than printing, all you do is print all this money right here so that you can loan it, okay, so the Federal Reserve can loan it to corporations, okay, to corporations for stock buybacks, okay, to move because remember, the people didn't have any money, and over here they don't have any jobs. These are all part-time jobs. So how are you going to create this bubble? Well, you had to create it, okay, the big guys, you had to create this big illusion, and what they decided to do is do quantitative easing, give money, print it, give money to corporations so they could buy their own stock. And so they would push the stock up from 100 to 185. Then also another way they did it, okay, was they would print all this money, and the Fed would take the money, right here, the Fed would take the money and they would buy the 10-year Treasury, the 10-year T-bill, 10-year Treasury, and the yields would drop down to, let's say, 1.8%. And who buys all these Treasury? Who comes over here and buys all these Treasuries to get interest? Remember China. Remember China, right? As I told you before, they print their yuan. And with those yuans, what do? They take the yuan and then they go ahead and they buy all the different they buy dollars with the yuan, and then they say to the Treasury, look, you guys are spending $6 billion a day more than you're taking in. So how about I do this? I'll give you the $6 billion over here. China gives you the $6 billion. All I want in return is give me interest, okay, of 4%, all right, and you can pay me off at a later date. 10 years Treasury, pay me off in 10 years. China's happy. They're making all this money. Well, to make the stock market go up more, they want to make sure China doesn't buy Treasuries anymore to get interest. So what do? The Fed comes in. And they buy all the 10-year Treasuries. So there's nothing left. And the yield goes down so low, when China comes in and they see the 1.86%, they go, oh, no. I was getting 4%. 1.8 now? No way. I will go and buy stocks. So you got the Fed. Okay, just think in terms instead of China. Fed is rigging it so China has to buy stocks. You got corporations buying stocks, and that's what's pushing this thing up. So what do you got to do now? Well, the same bubble is being created up here. Now the same thing's going to happen. Demand is going to stop, and that's what we're seeing right now. Okay, we're seeing demand stopping. Now, how do you know when demand is stopping? Well, you can see on your chart, and that's why we do charting instead of fundamentals. If you take your chart and you take and put up the S&P, the 500 best stocks, and you look on your chart, you bring it back a year, okay, and what you've seen in this last pullback here, you see this nice tight grouping, as we teach all the time right there, and the tight grouping now is broken down into these wild swings, which tells you there's no more demand, there's no more consensus that that things are good. So how do they keep this up here? They keep it up by just telling people it's good. It's that simple. The Fed, the president, his administration, everybody on CNBC, they keep telling everybody the economy is good, so they believe it's good when it's not good. But you can see the chart will tell you, and the chart's saying, So when you see this pattern here come from this pattern, so this is called pattern recognition, right? That's telling you, we got a problem here. So that there's a problem right here. It's no good. It's NG, no good. Okay, so we know this is no good. The next thing, the yield's at 1.8%. When the yield's that low, no good. That means there's a problem. So again, you got two indicators, okay? And you got the third indicator is we don't have a consensus pattern. Okay, so you don't have a consensus pattern, so that's no good. So that means that this market should start breaking down, back down like this again, down to this point right here. That's where this market should go, right back down here. Now, the only way it won't do that is if they come in with what? QE4. If they come in with QE4, which means, again, print all this money, to give to companies, again, to keep buying their own stock buybacks. Okay, but here's the problem: their own stock buybacks, and the other one, the big one, is to get China to switch from Treasuries to stocks. But the yields are already down to 1.8%. Okay, and interest rates are at 0, so there may not be anything left for this QE4. In other words, that's the problem with Europe. You know, they're dropping their rates, but their rates are so low already that it's not going to help. They think the QE in Europe is not going to help. Well, that's what can finally happen up here. If QE doesn't work this time, then what's going to happen? We'll lose 50%. From here, the market will go down in half. Because the market went up 200%. I told you before, it's overpriced by 50% because the GDP at 200% is 3%. It should be 7%, but it's 3%. So we're 50% overpriced. So this market could really take a real big hit. So in the meantime, what we're going to do is we're just going to continue to watch the market for our gang members, and then we will short the market. Okay, we're going to short the market, and we're going to know how to short the market because of our charting. When it turns red, every time it turns red, here's the S&P, we know the market's going down. institution money is coming out. Look right here, went from green to red. If this takes this low out in here, then that means, hey, things are going to go really bad. But here's the real key. The key is right here, the banks. So the banks, if you take a look at the banks right now, if they start breaking, see how the banks are breaking down? Banks always lead the market first. Here's your stock market going up. What pushes the market up, the first thing is bank stocks. Without bank, they start to lead. Without the banks, you have no stock market. The banks have to push the market up first, because all the institutions and Goldman Sachs, they watch, and as bank stocks going up, they'll buy stocks. So right now, if the bank stocks collapse, if the XLF here collapse, okay, then this market could go down 50%, and that's what I'm looking at. So I'm looking at a 50% correction, but in the meantime, we may get some more of these 10% corrections. We'll get more of these wild swings like this, okay, before they discover that, hey, everybody's out of bullets. This is the end of the deal. It's been 7 years, for God's sakes, all right? So that may happen. So, but we're looking for more of these. See how this is pulling back now? So this is what we're looking for right here. This is exactly what we're looking for. Here's one here. Now we're looking for another one. Come down to here again. And this is what we're going to be looking for, this stuff. And this is where you're going to make a lot of money in the market. And using our PT2 is easy, because every time it turns red, we sell. Every time it turns green, we buy. All right? So that's what I think is going to happen. We're going to get more volatility, and then we'll eventually get a big collapse, and then everybody's going to come in, all the big guys with money, and start buying again. And I think this all happened by this fall. So I think we'll get at least a 20 or 30% pullback by this fall and get a nice correction in this market. In the meantime, we're just going to keep doing what we do every day, use our charts, and we're going to, with our technique of relative strength methodology, and just keep buying good stocks. That's all, in shorter periods of time. Hope you enjoyed this, and now you may understand a little bit better why we have these bubbles and what I think is going to happen with this third bubble called quantitative easing bubble. These bubbles never last. They all break. See you on the charts.